Understanding the dynamics of monetary and non-monetary forces on prices provides insights into how economies function, grow, and eventually face systemic challenges. This analysis explores how money supply impacts prices, the role of non-monetary forces in moderating these effects, the eventual dominance of monetary forces, and the consequences in the form of hyperinflation. Case studies from Turkey, the UK, and Israel offer practical examples, while the enduring relevance of gold as money underscores the limitations of fiat currencies. At the heart of every economic transaction lies an exchange between money and goods or services. The monetary side of this equation, money supply, has a profound effect on prices through the basic principles of supply and demand. An increase in the money supply, all else being equal, generally leads to higher prices. This phenomenon is straightforward. When there is more money chasing the same amount of goods and services, prices rise. This is evident in periods of loose monetary policy where central banks inject liquidity into the economy to stimulate demand. However, this immediate relationship between money supply and prices is not the full story. Over time, non-monetary forces can counterbalance the inflationary effects of an expanding money supply. For example, when lower interest rates, a consequence of increased money supply, spur investments in capital projects, the resulting increase in production capacity can moderate price rises. Non-monetary forces act as a counterbalance to monetary inflation, at least temporarily. These forces are rooted in the real economy and involve productivity gains and resource allocation. When central banks increase the money supply, interest rates typically fall. Lower interest rates make borrowing cheaper, encouraging businesses to invest in capital-intensive projects. These investments can include infrastructure, technology, or resource extraction, all of which increase the supply of goods and services in the economy. As investment grows, so does the ability to produce and extract commodities. For instance, a mining company might use cheap loans to develop new mines, increasing the supply of raw materials like copper or oil. This expanded supply can drive down commodity prices in the short to medium term. Despite these moderating effects, non-monetary forces are not infinite. Over time, the monetary forces of increased money supply outweigh the productivity gains from capital investments. Prices start to rise again as the initial boost in supply dwindles in comparison to the continuously expanding money supply. Hyperinflation represents the extreme end of the monetary forces spectrum, where the unchecked expansion of the money supply outpaces an economy's ability to produce goods and services. Governments often resort to printing money to finance deficits or meet short-term economic needs. However, this creates a dependency on ever-increasing amounts of money to sustain the system. Over time, the required rate of money supply expansion grows exponentially, as seen in countries like Turkey. The supply side of the economy has natural constraints. No matter how much capital is invested, there is a physical limit to how quickly resources can be extracted and goods produced. When money supply growth vastly exceeds these limits, prices spiral out of control, leading to hyperinflation. Examining real-world examples helps illustrate how monetary and non-monetary forces interact and the consequences of mismanaging these dynamics. Turkey provides a striking example of how excessive money printing can lead to currency devaluation and inflationary pressures. Over the past decade, Turkey's central bank has frequently resorted to printing money to finance government spending and stabilize the economy. This policy has led to a rapid expansion of the money supply, causing the Turkish lira to lose significant value against major currencies like the US. The inflationary effects have compounded as the government continues to inject liquidity, unable to halt the process without risking a banking collapse. The United Kingdom's response to economic pressures during the COVID-19 pandemic has raised concerns about hyperinflation risks. During the initial lockdowns, the UK became one of the few developed nations to allow its central bank to directly finance government deficits. This unprecedented move, combined with widespread government wage support programs, led to a significant expansion of the money supply. While not yet in a hyperinflationary spiral, the UK faces long-term risks as its economic system adjusts to these radical measures. Israel's hyperinflation crisis in 1984 offers a rare example of a successful intervention to prevent economic collapse. During the early 1980s, Israel faced triple-digit inflation driven by excessive money printing and direct central bank financing of government deficits. The crisis was resolved by restructuring the Bank of Israel's operations, making it illegal for the central bank to directly finance deficits. The introduction of a new currency, the new shekel, stabilized the economy and restored confidence in the monetary system. Gold has historically served as the foundation of monetary systems, and its relevance endures in the face of fiat currency instability. Unlike fiat currencies, which derive their value from government backing, gold has intrinsic value. This makes it a reliable store of value and a hedge against inflation. The monetary regression principle suggests that all currencies derive their value from a historical connection to a commodity, typically gold. Even the US dollar originated as a gold substitute, anchoring its value in the past. When fiat currencies face devaluation or collapse, gold's value rises in comparison. This is not merely a market reaction, but a reflection of gold's enduring role as a monetary standard. Fiat currencies are inherently flawed due to their reliance on continual expansion to sustain economic activity. The injection of liquidity into the economy creates dependencies. Businesses and consumers adapt to the increased money supply, requiring further injections to maintain stability. This creates a feedback loop where central banks must continually expand the money supply to prevent deflationary crashes. Each round of expansion necessitates even larger injections in the future, pushing the system toward hyperinflation. The reliance on monetary expansion to address economic challenges sets a predetermined course towards systemic instability. Once a central bank begins injecting liquidity into the economy, reversing course becomes nearly impossible without significant economic restructuring. Attempts to reduce liquidity risk triggering deflationary spirals, leading to widespread economic collapse. As money supply expansion accelerates, the system enters a hyperinflationary phase. This is characterized by exponential price increases, loss of confidence in the currency, and the eventual collapse of the monetary system. The interplay between monetary and non-monetary forces shapes the trajectory of prices in an economy. While non-monetary forces like capital investment can temporarily moderate inflation, the long-term dominance of monetary forces often leads to systemic instability. Hyperinflation, as seen in Turkey and other historical examples, highlights the dangers of unchecked money supply expansion. Gold's enduring role as money underscores the limitations of fiat currencies, which rely on continuous expansion to sustain economic activity. Ultimately, without significant restructuring, the current reliance on liquidity injections sets a predetermined course toward hyperinflation, with profound implications for global economic stability.